Welcome to the Deep Dive. We're here to cut through the noise of earnings calls and bring you the insights that really matter.
That's right. And today we're digging into Equifax's second quarter 2025 conference call.
Yeah, it's a really interesting one. A company with a pretty resilient business model, but facing some, significant headwinds from the wider economy.
Definitely. We'll unpack their performance and try to figure out what it signals for them going forward.
So let's jump right in. The quarter itself.
It was impressive. Honestly, very strong results. Total revenue hit $1.54 billion.
Okay, big number.
Yeah, and that's up 8% if you adjust for currency, 7% as reported. But here's the thing. It wasn't just good. It was $27 million better than the midpoint of their own guidance from April.
Wow.
And get this, it's the highest quarterly revenue they've ever posted, ever.
That certainly sets a positive tone. What about the bottom line, adjusted EPS?
Also strong. Came in at $2 per share, which beat their guidance midpoint by a solid 10 cents. So, that points to some really good operating leverage from that higher revenue, plus smart cost control.
Right. So even with those known weaknesses, the mortgage market, hiring slowdowns, they still managed to over-deliver.
Exactly. They really executed well.
Okay, let's dig a bit deeper then. What about profitability margins?
Yeah, so their adjusted EBITDA margin, that's a key profitability measure for them, was healthy, 32.5% for the quarter.
And how are they using their capital? I know they have a buyback program.
They do, a new $3 billion program, actually. And they put it to work, repurchasing $127 million in shares just this quarter. Add the dividends, about $62 million, and they returned $190 million to shareholders in total during Q2.
That's a fair chunk of change going back to investors, but can they sustain that? How's the cash generation?
Really robust, actually. Free cash flow was $239 million in Q2.
Which is up significantly from last year, right?
Hugely. Over $100 million more than Q2 2024. And they're feeling confident about the full year, too, forecasting over $900 million in free cash flow.
Wow.
Yeah, with a cash conversion rate over 95%. That really shows the power of the business, especially now they're, wrapping up that huge cloud migration project.
Okay, so the overall picture is strong, but where's that growth actually coming from? Let's break down the business units. Workforce Solutions, EWS, it's usually the engine.
Still is. Revenue there grew a solid 8%.
And the drivers?
Well, Verifier was strong, up 10%. The government business was really impressive, up 14%. And consumer lending packed a punch, up 19%.
Even mortgage within EWS saw some growth.
We did, yeah, up 9%. Yeah. Decent, considering the overall market softness there.
What about the talent solutions side? Hiring's been weak, particularly white collar. Did that show?
It did, but kind of as expected. Talent solutions revenue was up about 4%. They did mention a bit of a slowdown in hiring transactions recently, which also hit their employer onboarding side, down about 2%. But even with that, EWS margins were great. 53.3% adjusted EBIT margin. That's up 50 basis points year over year, mostly thanks to that higher revenue and, again, tight cost management.
Let's talk about that government business surge. Up 14%. Management seemed quite bullish there, right? Mentioning the administration's focus on improper payments.
Oh, absolutely. They highlighted the $160 billion figure the administration is targeting in improper social service and tax payments. It's a massive number.
And there's actual legislation backing this up now?
Yes, the OBBA Act. It's creating real opportunities. Things like more frequent checks for Medicaid eligibility semi-annually instead of annually, plus new work requirements, and linking federal S&AP funding to state error rates.
So real incentives for states to use services like Equifax's.
Exactly. And Equifax is right there in Washington, working on potential roles in new federal programs, too, like IRS EITC verification, a do-not-pay system for unemployment, stuff with the Department of Education.
Plus, they're innovating internally. That integrated income solution sounds interesting.
Yeah, launching next quarter. It combines the work number data with consumer permissioned bank data that helps capture gig work, self-employment income stuff that's harder to track traditionally.
Sounds powerful.
It is. Now, they did flag some potential, choppiness in revenue in the second half of this year for government, mostly related to states adjusting to prior funding changes.
Okay.
But long term, they are super confident. They're talking about exceeding 15% growth in that segment, targeting what they see as a $5 billion market. They're only at about $800 million now, so huge runway.
And underpinning a lot of that is the work number itself, right? How is that database growing?
Relentlessly.
Yeah.
Active records are up 10% year over year, almost to 200 million now, 198 million to be exact.
Wow.
Total records also up 10% to 767 million. and they keep adding companies 1.3 million more contributors in the last year, bringing the total to 4.6 million.
What about current records, the really active ones?
Good point. Those are up too. 113 million records paid in the last 35 days. That's up 9%. And 100 million current SSNs, up 8%. It just shows, how much room they still have to grow towards capturing all 250 million income-producing Americans.
Okay, let's switch over to U.S. Information Solutions. How did they fare?
Also a very strong quarter for them. Revenue up 9%, which was better than expected.
Driven by?
Primarily mortgage revenue, actually. Non-mortgage was decent, up over 4%, but mortgage really drove the beat.
That is interesting, because wasn't the overall market for mortgage inquiries down?
Sharply down. Yeah, U.S. mortgage hard inquiries fell about 8.5% in the quarter.
So how did USIS manage a 20% surge in mortgage revenue? What's the secret sauce there?
A couple of things. Price increases played a role, especially on credit scores. And they saw really strong growth in their pre-approval and pre-qualification products. They're actively gaining share in that early stage of the mortgage process.
It makes sense. And margins.
Margins were great there too. 35% adjusted EBITDA margin, up 180 basis points. That's benefiting from cloud savings kicking in, plus that operating leverage.
And innovation, the Vitality Index.
Yeah, that accelerated nicely to 10%, right in line with their long-term goal.
Yeah.
It shows the new cloud platform is really enabling faster product rollouts that are actually, generating revenue.
Like the new AI-powered stuff, EFX.AI.
Exactly. They've already launched that new twin indicator solution for mortgage credit.
Twin indicator.
Yeah, it combines traditional credit data, alternative data, and these income indicators from presumably EWS data. They're expecting similar products for auto and personal loans later this year.
And the strategy there.
This is clever. They're offering the twin indicator feature at no extra cost.
Really?
Yeah. The idea is to differentiate their core credit file, make it more valuable, and use that to grab market share. It's a pretty bold competitive move.
Interesting. Okay, quickly on international.
Solid. Grew 6% in constant currency. Pretty broad-based growth.
Yeah.
Latin America was the standout, up 11% thanks to new platforms in places like Argentina and Brazil.
Europe, Asia Pac.
Europe improved, up 6%. Asia Pacific up 4%. Canada was a bit softer, only 1% growth. They flagged weaker economic conditions and maybe some tariff concerns there.
And margins internationally?
Also improved, up 80 basis points to 26.4%. Again, helps by revenue growth and those cloud efficiencies.
Okay, so summing up the performance. A really strong first half across the board, which makes their guidance maybe a little surprising. They basically held the line on constant currency guidance from April. Why so cautious?
Yeah, it does seem prudent, doesn't it? They put it down to basically heightened economic uncertainty. Worries about hiring, interest rates, mortgage volumes just not recovering yet.
So no big upgrades based on the strong first half?
Well, they did nudge up the reported full-year guidance slightly. Revenue now expected around $6 billion, adjusted EPS around 7.48 cents. But they stressed that was purely due to favorable FX rates, not underlying business strength improving beyond April's view.
Got it. And the outlook for the specific segments for the full year?
A bit of a shift there. Workforce Solutions growth is now pegged around 5% for the year, down from 7% they guided in April. They expect the second half to be a bit softer due to that hiring and government volatility we talked about.
But USIS is looking stronger.
Correct. They now expect USIS revenue to grow about 7% for the year, which is better than April. And within that, mortgage revenue is projected up around 13%. International stays around 7% constant currency growth.
So a bit of a rebalancing between the segments based on current trends. What about costs? Anything unusual there?
They did flag higher corporate expenses for the full year, around $590 million.
Driven by
mainly increased consumer litigation costs. Seems they're resolving more single plaintiff cases and seeing a higher volume of smaller claims, plus some one-off costs. So that'll eat into the strong business unit margins a bit.
And the specific outlook for Q3?
They're projecting total revenue up over 5% constant dollar. But they noted it's a tough comparison against a very strong Q3 last year. Adjusted EPS expected between $1.87 and $1.97.
Okay. And the assumptions behind that? Mortgage market's still looking pretty bleak in their view.
Very much so. They expect hard mortgage inquiries to decline over 13% in the second half. Basically, no recovery baked in. They point to mortgage rates staying high, over 6.7%, plus high house prices, low inventory, the usual suspects.
And remember, inquiries are still way down from historical levels.
Over 50% down from the 2015-19 average. Yeah, massive gap.
And the hiring outlook? Still cautious.
Still cautious. Corporates are nervous about the economy, inflation, tariffs. It's dampening new hiring activity, even if there's still churn. They also mentioned they're thinking about the longer-term impact of AI on hiring patterns.
Right, that's a big unknown. What about Vantage Score? Any movement there?
Their happy FHFA supports tri-merge reports, but they were pretty clear that getting Vantage Score widely adopted in mortgage will be slow and complex. FICO's just too embedded right now.
And pricing? Assume those increases from the start of the year are baked in.
Yeah, broadly speaking, they did implement price adjustments across the board back in January, and clearly those larger increases for mortgage credit scores in USIS are showing up in the results.
Okay, let's zoom out. They talked about their long-term financial framework out to 2030. They reconfirmed the 7-10% organic growth target.
Right. And they laid out two interesting scenarios. The first is their base case.
Which assumes?
Crucially, it assumes no significant recovery in the U.S. mortgage market, just modest 2-3% annual growth, mid-single-digit pricing.
And in that scenario, where do they end up by 2030?
Around $9.6 billion in revenue, over 35% EBIT margins, and roughly $15 in adjusted EPS. That implies an 8.5% compound annual growth rate.
Okay, so solid growth even without help from mortgage. But then they gave a recovery scenario.
Yes. This is where it gets really interesting. If the mortgage market simply gets back to the average volume levels we saw between 2015 and 2019, remember, we're currently 50% below that.
Okay.
Then revenue could hit approximately $10.8 billion by 2030. That's an 11% CAGR. And adjusted EPS could reach about $19 per share.
$19. That's a huge difference from the base case of $15.
It is. $4 of potential upside, and they stressed that this recovery scenario is actually conservative. It assumes no extra benefit from new products, pricing, market share gains, or record growth beyond what's already baked into 2025.
So any mortgage recovery just flows straight through to the bottom line, boosting margins and EPS and likely leading to more cash returned via dividends and buybacks.
That's the message. They believe they can deliver their long-term goals without a mortgage recovery, but there is significant potential upside if or when one eventually happens.
Okay, let's try and put this all in context for listeners. What really stands out here? For me, it's that resilience, Q1, Q2. Strong execution despite very tough mortgage and hiring markets. It really validates their business model, especially post-cloud transformation.
Absolutely. And that cloud completion feels like a real turning point. Like they've finished building the highway, and now they can focus on driving innovation much faster. That 14% NPI vitality shows it's already happening.
And that strategic move with the twin indicator, giving it away free to boost the core credit file, that's a smart, aggressive play for market share.
Definitely. And then there's the government business. We talked about the $5 billion addressable market versus maybe $800 million revenue today. Even with some near-term bumps, the long-term tailwind from the focus on improper payments seems really strong.
But on the other hand, you can't ignore the headwinds. The economic uncertainty is real. It's hitting hiring. It's making them guide cautiously for the second half.
Right. And those rising litigation costs are something to keep an eye on as well. It feels like Equifax is entering a new chapter, leveraging the tech, the data, pushing these multi-data solutions, chasing big growth opportunities, but still needing to navigate these tricky market conditions.
Okay, it's that time. Our This Is Not Financial Advice segment. We look for an outrageous but plausible idea based on the call.
And given everything we've discussed, the strong core business, the cautious guidance, but that huge potential mortgage upside, our idea today revolves around that.
Specifically,
Consider a long position in Equifax, essentially playing for the unpriced upside of a potential mortgage market recovery.
okay, let's break that down. The outrageous part.
The outrageous part is you're betting against the company's own cautious guidance and base case scenario, which explicitly doesn't assume a meaningful mortgage recovery. You're betting on something they aren't promising in a market that's frankly been terrible.
Yeah.
Remember, inquiries are down over 50% from recent averages.
Right, so why is it plausible?
The plausibility comes from the sheer scale of the pent-up demand. Their own data shows nearly 13 million 30-year mortgages taken out since 2022 have rates above 6%. 9 million are above 6.5%.
That's a massive pool of potential refinances just sitting there.
Exactly. Millions of homeowners just waiting for rates to drop. If rates do fall meaningfully, even just partially, that existing pool could unleash a significant wave of activity. And that's the catalyst that could drive Equifax towards that $10.8 billion revenue and, crucially, that $19 EPS figure by 2030.
that $4 of ETS upside beyond their base case, and that's before you even factor in any further innovation or share gains they might achieve after 2025.
Precisely. It's like a call option on a macro turnaround. You get the resilient base business, but with potentially significant leverage if the mortgage market wakes up.
Okay, interesting idea. So to recap today's deep dive, Equifax delivered impressive Q2 results, showing the strength of its cloud-powered model even in a tough climate.
Yeah, they're investing strategically, especially in innovation and that huge government opportunity.
But macro uncertainties definitely remain, leading to cautious guidance. Still, their capital return plans and those long-term scenarios suggest continued growth and value creation.
Though, as always, remember, this discussion is purely for informational purposes. It is absolutely not financial advice.
Definitely do your own research, dig into the details, consider all the angles. So what stood out to you about Equifax this quarter or their longer-term view? Let us know what you'd like us to tackle next time on The Deep Dive.